So for a while I've been talking about recession, and a lot of people just kind of dismissed it because the markets were going up, but the markets always go up before they go down. I've been warning that this could happen. I just couldn't tell you when. The markets are shedding hugely right now. Matter of fact, they're crashing. The Nikkei was down 12.4%. The US markets are following, and all markets almost worldwide are down. So what does that mean? In this video, I want to go over the 4 reasons we could be headed to a recession. My name's Chris Naugle, and this is What Now? What's Next? People always seem to react a little bit too late, as if they want confirmation that the markets are going to start collapsing. Sometimes that's too late. Some of the things you should have been looking for all year are just the signs, and those signs are very easy to see. I've said it before, it's like that song, signs, signs, everywhere there's signs. There has been signs all over the markets. Kind of like, why has the market been making new highs? Is there any real reason when the economy's actually slowing down? Why is the Fed holding rates higher? And it isn't just because of inflation like they tell you. The Fed has some major tools that they can use to combat slowing down economies, recessionary periods, and one-day corrections like you just saw happen. But those reactions can't be used too early. Otherwise, it'd be like a gun that you empty the chamber just a little too soon. So you probably just want me to get to the chase. Why are we headed to a recession? So let's start with the first reason we're headed to a recession, and it's simple, it's cycles. Market cycles, economic cycles. But there are 3 that I want to point out, and these 3 are talked about by a lot of experts like Ray Dalio, Warren Buffett talks about this. The first one is the short-term debt cycle, which is every 5 to 7 years. So if you take that back, that puts you right at the pandemic. About a year early. So like I said, it can be 5 to 7 years. So we're not going to get it exactly, but really what we're looking at is debt cycles. So this would be a short term, meaning short-term interest rates. Well, if you think about interest rates, what happened? Well, they were really low after the Great Recession, and then they started climbing back up, then the pandemic hit, and they went really low again, and then what'd they do? They raised them for inflation. So if we did the math in between there, we're gonna hit pretty much right on the mark. And the next cycle that we gotta talk about is the technology cycle. Usually 25 to 30 year cycle. So if you take that back, that puts you right around the time of 2000, and shortly thereafter was the dot-com recession. And the last cycle is one none of you have ever lived through because you're not old enough. None of us are. And that is the long-term debt cycle. It's about every 75 to 100 years, which if you do the math, puts you right around the Great Depression. And the second reason, the inverted yield curve. You've heard about this. Let me tell you more about what this thing is. So this one is one I really like to talk about. The inverted yield curve is when you're paid more for owning short duration bonds versus long duration. Usually they refer to this when they're talking about treasury bonds. Now I don't want to get technical, but just think of it this way. If you're paid more for buying a 2-year bond, meaning in 2 years you get all your money back, you're paid more there than you are for buying a 30-year bond where you got to wait 30 years for the bond to mature. Which one do you think should pay you more? The long one, right? Because you got to wait longer. But you see, there's more risk in the short term than there is in the long term right now, which is why you're paid more for owning short term bonds. It's like an X, but right now, the inverted yield curve, just looking at history, has never been wrong. It has always happened before a recession. So let's talk about the third reason. It's an election year. I mean, come on. Every election year that I have looked at, and I've gone back 5 elections, has done the same thing, especially when there's a president running for a second term, or there was a president running for a second term. Anyway, election years are goofy years in the markets. In my opinion, they always involve a little bit of speculation, a whole lot of manipulation. But right now, what you're seeing is you're seeing us in an election year where the markets have gone up, up, and up, even though the economy is slowing down. Does that make any sense? Well, no, it shouldn't make any sense. Matter of fact, when you look at the S&P 500, the 500 stocks, it was dominated by 7 stocks, technology stocks. So when you focus in on that and you look at the fact that we're in an election year, things don't add up. And what's happening right now? A worldwide sell-off. Warren Buffett Berkshire Hathaway is what you should probably focus on, just sold a ton of stock. Just this morning, we heard that they sold half of their Apple position. Apple, that's like the almighty stock. Why would you get rid of half of it? Do you think he knows something that maybe you don't know? It's not just him, it's all of them. They know what's coming. Therefore, they're getting out, sitting in cash, like so many of us should be doing, and they're getting ready to buy the ultimate buying opportunity, which is easy. Buy low, sell high. So they're selling high, getting ready to buy low so that they don't lose money. Folks, don't play around with this. You can see the signs, and this is just the third one. It's an election year. Get out, take your profits and sit in safety. And where's some safety? Well, we'll get to that in a second. So I figured at this point I should just give you a little kind of bonus round, right? So if all those things are happening, the three signs are happening, where would be a good place to put money? Well, what do you think the Fed's gonna do if we enter a recession, if the economy slows down? We don't even need to think about what the Fed's gonna do. They've already said there's a strong chance they're gonna start dropping interest rates. Not even a chance. They will start dropping interest rates. And when they do, where is the best place to make money? Talked about this before, I've mentioned this, you should all know this, and if you do know this, put it down in the comments. Treasury bonds, long duration treasury bonds. You can go to treasurydirect.gov. Now, I'm not making a recommendation here. I'm just telling you, it kind of makes sense, because if interest rates went up, that means the price of the bonds went down. So now if we flip that and we know interest rates are going to go down, well, then we know the price of the bonds are going to go up. I think that's a great place. They're not sexy by any means, but hey, do you need something to be sexy if you think it's going to make you a bunch of money? I don't. And let's talk about the fourth reason. Now, there's a lot more than four, but I wanted to keep this simple. Employment. How about the jobs numbers? Have you been watching them? I have. Now, it seems every time they put the jobs numbers out, they look great and everybody's, woo, yes, everybody's employed. But then they revise the numbers and they don't look so good, but you see, nobody's paying attention. But just recently, people are paying attention because Intel just laid off 15% of its workforce. We're talking about Intel, the chip maker. But who cares about Intel? Let's just look at the unemployment numbers. For 4 straight months, the unemployment rate has gone up, which means there's more and more people becoming unemployed. Now, you're not hearing about this. It's an election year, I already covered that, but it's happening. And it's happening because the economy's slowing down. And when the economy slows down, people lose their jobs. Companies cut the proverbial fat, and it's happening. So if you really want proof, just turn on the TV. Watch the news channel. Doesn't matter which one. They're all feeding you full of a bunch of crap, but jobless numbers, you can see what's happening there. So if we put all 4 of these together, the cycles, remember we talked about the 3 cycles, short-term debt cycle, long-term debt cycle, technology cycle. We then went into the fact that we're sitting in an election year. After the election year, I mentioned the inverted yield curve, which I've covered so many other times, but don't take my word for it. Just look at every expert out there. They're talking about the inverted yield curve and what that means. And it always lands the same place. And then I finished up with the last one, all of us being employed. So if we're not employed, well, then we can't service our car payments, our debt payments, our mortgage payments. Definitely can't pay those credit card bills. If you look at those charts for credit cards, they're through the roof. But not only that, they're not just through the roof. The credit card companies are charging 20 to 29% interest. Wouldn't you just like to make that return? I can show you how to do that. I can show you how to build wealth through your own debts and expenses. But again, don't take my word for it. It's all over the place. You could follow the book, Becoming Your Own Banker, our Nelson Nash. You can follow all the books and it will show you the path to you getting out of debt and building wealth through all those debts. Now, I know that this video is a little informal, not like the other videos I put out, but I had to get this video out because this morning, like I mentioned, the markets are crashing. The Nikkei dropping 12.4%. Our markets down over 3%. That's big, folks. And you needed to hear this. So, what is the solution? Check out Treasury bonds. Look at what's been happening to the price of those long-term treasuries. You can go to treasurydirect.gov, you can call your financial advisor, you can get advice from your financial advisor, but chances are they're just gonna tell you the same old thing. This is too soon to make it a reaction. It's just a paper loss. Yeah, last time I checked, it's your money, not theirs. So you need to be a good steward of your own money and make decisions based on what suits you best, not what suits their paycheck best. Look, I'm not here to try to scare you. That's not my goal. I'm just trying to get you prepared. And I looked at the VIX this morning, which is a gauge of fear, volatility. It's spiking. So I already know people are scared. So the best thing you can do is take action. The best thing you can do is just logically make a decision. Too many people make investment decisions using emotion, and it usually leads them to losing money. If you just use logic, just follow these simple 4 things that I just told you. Look at what it takes for you to become your own bank, what it takes for you to take a position in treasuries. I mean, look at the experts, Ray Dalio. Look at his all-weather portfolio, 55% in treasury bonds and bonds. Find safety, folks. Don't ride this out. Don't wait this out. Don't assume that this is just a paper loss. It's your money. It's your future, and it's your kids' legacy. I think you owe it to yourself to look at this seriously. Because hey, if you really want the truth, when you lose money in the markets, it takes a lot more gains to get back what you lost. And final, check out the drawdown effect. That will get you to take action. With that being said, my name's Chris Naugle, and thanks for joining me for another What Now? What's next? And what's next is all up to you. Hey guys, if you like this video, check this one out right here. A view from 2025. I think you'll like it.